Hello, my name is Lachlan St. Clair and welcome to the May edition of Smart Money. I had a quick look at our last Smart Money and all we did was focus on what was going to happen if Labor gets in the federal election and get up, and obviously that didn't happen. So we thought it probably most appropriate to just quickly run through, now that the coalition's in government, some of the changes or the impacts that's going to have on things domestically. So firstly, the interest rates. I think it's fair to say that had there not been a federal election, the RBA would have cut interest rates at the beginning of May, but it is quite a politically charged topic. So the RBA really looked around for an excuse to hold off making that change or making that cut, and they sort of hung their hat on unemployment, which at the time was 5%. Unemployment since jumped up to 5.2%, and Phil at Lowe's essentially came out a week or so back, the governor of the Reserve Bank, and said we will be cutting interest rates at the next meeting. So we definitely expect a 25-point cut in interest rates at the beginning of June. I think it's probably fair to say another 25 to 50 basis point cut over the next 12 to 18 months or so. So interest rates are definitely on the way down. On housing, one thing when the Labor were proposing was obviously a lot of taxation around housing. So the reduction in capital gains tax exemptions, reductions in negative gearing, a lot of policies that weren't particularly supportive for housing. I think it's fair to say now that coalition has gotten in, there's a lot more optimism around the property market, which is great, obviously, for people that own homes. And importantly, and this isn't directly by the government, but APRA have come out and made a change to how the servicing rate is calculated on home loan mortgages. So, and this is important. So the way it is at the moment, or the way it was up until recently, was that no matter what the interest rate was at the time, you had to be able to service your mortgage at an interest rate of 7.25%. So that obviously was quite constrained because it's a long way above where interest rates are now. And most importantly, it also meant that if the RBA reduced interest rates, serviceability didn't change because the servicing rate was at that fixed level. What APRA came out and said a week or so back was they're going to change that from a fixed 7.25% to change it to a 2.5% margin above the prevailing variable rate. So if the variable rate's 4%, you've now got to meet a servicing rate of 6.5% as opposed to 7.25%. So that should mean a lot more people can access a lot more money in terms of their serviceability, which puts more credit into the housing market, which really should be supportive of property at the end of the day. We're certainly hearing anecdotally, you've got a number of clients selling properties at the moment, that since the election, contracts and numbers for auctions have gone up, interest seems to have gone up. I know Macquarie and HSBC called the bottom of the market a week or two back. We're certainly expecting by the end of the year, certainly to have found a floor in the property market, potentially even coming back up a bit as well. So that's obviously a good thing for property owners. I also want to make a comment about iron ore. Iron ore is critical in Australia, and it's really the only reason, or one of the only reasons, the government delivered a potential budget surplus when Frydenberg handed it down. The price of iron ore has actually risen by almost 60% since the beginning of December. So the last 6 months, it's a 60% increase in the price of iron ore. And that's really been driven by a reduction in supply because there was a big dam collapse in Brazil, so it shut down their supply. About a third of the world's production's gone. And a big increase in demand from China as their stimulation takes effect and infrastructure starts to spend. So that's been really positive for Australia, for the federal government. It's also been very supportive for the Aussie dollar and has really offset the downward force on the Aussie dollar that you're getting at the moment, because US 10-year government bonds are actually paying a higher yield than Australian 10-year government bonds. So all other things being equal, the US government's probably worth it, is a more secure bet than the Aussie government. So that should put downward pressure on the dollar. The fact the dollar hasn't moved too much is indicative of just how much that iron ore is flowing through our economy at the moment. So something really to keep an eye on. If that iron ore price falls away, things will could get pretty nasty for Australia. The other comment I wanted to make, or the final comment I wanted to make, was on the trade war between China and the United States. This is probably the biggest global issue floating around at the moment from an economic perspective. Basically what you've got is Trump has put a 25% tariff on a whole bunch of goods that are coming out of China. And at the end of the day, it's the US economy or the US consumer, I should say, that pays for that. The price of shoes and iPhones and all that sort of stuff goes up. And Trump is essentially betting that his economy is strong enough to force China to back down. Now, that's a big call. The US is very late cycle, as those of you who follow my podcast would know. And he could easily tip the United States, I should say, into a recession. By the same token, China's actually, its economy starting to improve quite significantly as well. Some big stimulus they took advantage, or they put into their economy late last year, starts to bite. So you've got two big economies in quite strong position, having a pretty big economic barney at the moment. And the problem for Australia is there are a lot of ways to lose. Either the trade war continues on and slows the global economy down even more, tips it into recession, certainly a possibility. Australia never goes well with that environment. The second issue for Australia is if Xi Jinping decides, I'm just going to shut Trump up and just promise to buy $200 billion worth of primary production goods off the US to even up the trade balance, a lot of that stuff is going to come at the expense of things that we sell China. So, wheat and soybeans and cotton and lamb and beef and all those sorts of things that Australia sells. If China, promises to buy $200 billion more from the United States, then they're going to buy $200 billion less from their other suppliers, of which Australia is a key component of that. So there's quite a few ways for us to lose in the trade war, and we really are quite concerned. I suppose the last comment to make now that the coalition's in is obviously self-managed super funds. The imputation credit issue is gone. All those self-managed super funds we're looking to shut down the second half of this year. We no longer need to do that, which is a good thing. And I think it's also fair to say it'll be a pretty brave government that brings an election policy, brings a tax policy to an election that contains any element of taxing retirees. I just really think that's off the agenda politically. So that's it for this edition of Smart Money. If anything we say or spoken about, you think we need to review your portfolio out of cycle, you're always welcome to give us a buzz. Otherwise, we'll look forward to seeing you when you are next due for review. Thank you for watching.